said I wanted a divorce. I've said the same thing over and over again, and you say all the right words, but your actions don't change.
Welcome to The Important Part, a podcast about achieving financial independence by making smart investments in yourself and your portfolio. I'm Liz Thomas, your host and head of investment strategy at SoFi. Today, we're doing something special. A joint interview with two remarkable people who exemplify what it means to build wealth with purpose together. Most entrepreneurs face an impossible choice. Sacrifice your relationships for success or sacrifice success for your relationships. What if the secret to lasting success isn't just about what you build, but who you build it with? Today's guests have spent 25 plus years proving you can have both: a thriving career and a thriving marriage, financial success and meaningful impact. Brad Feld is partner and co-founder of VC firm Foundry Group, co-founder of Techstars Startup Accelerator. Amy Batchelor is managing director of the Anchor Point Foundation, and together, Brad and Amy co-authored Startup Life: Surviving and Thriving in a Relationship with an Entrepreneur.
This podcast is sponsored by SoFi to help you get your money right and is for informational purposes only. Nothing in this program is a recommendation from SoFi. You should not rely on this program for any financial, legal, or tax advice or recommendations. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
Brad and Amy, welcome to The Important Part.
Hello. Thanks for having us.
Absolutely. So there's so much that we're going to talk about today. We'll talk about managing money. We'll talk about tech companies. We'll talk about the Rule of 40. We'll talk about entrepreneurship, mental health, all of the things. But I want to start with why we have both of you today. By the way, this is the first time I've had a couple as guests.
You're honored to be the first.
What we're going to talk about with both of you first is how to navigate all of this as a couple. And I think that that's a really important conversation that we just don't have enough. So let's talk about decision-making and success in decision-making. So first, as just kind of an intro to everybody, you guys have been married for more than 25 years. Brad as the entrepreneur and Amy as the community leader and philanthropist. From the outside, it looks like you have unlocked the secret to having it all. You guys have figured it out. But we all know that there's really no such thing. It takes a lot of hard work. So let's start with finding your personal purpose and pursuing it. Talk to our listeners about the idea of knowing yourself well enough to choose the right professional path. A lot of our listeners are younger, so still trying to figure out what that path might be.
Yes, I actually worked for Brad's company. I was the fourth employee, which is complicated. And now that things have changed some in terms of rules, I'm not sure that we would be dating. He was never my boss. I technically never reported to him, but we did start going out when we worked together. And then not long after we started going out, maybe 6 months, I stepped away from the company. It wasn't a formal HR kind of a thing. We were still small, and it was 1991. But I also knew that what I really loved was writing and language, and being with somebody who had already had some financial success did allow me to leave the paid workforce and pursue my dream. And that's also a really complex thing for couples to navigate when one person is earning money and the other person isn't. But Brad's always been extremely supportive of my non-earning creative work.
That is hugely important. And let's talk about then the decision of the partner you choose. And just for background too, so I'm obviously in finance. My husband is an artist, architect, designer, sort of, that creative mind. So as you can imagine, we are on opposite ends of the spectrum in a lot of ways. And when you choose the partner, you sort of know up front what you're getting into, but there's a choice to to be with the person initially, but then there's a choice to stay in it and realize maybe how different you view the world and how different your lives are and your different goals and all of it. So let's bring the entrepreneurship into the conversation here. Because Amy, you started pursuing your dream of being a writer. And you mentioned Brad had already had some financial success, so that opened the door, gave you the freedom to do so. But you were also now in a relationship with an entrepreneur, which is an animal all on its own.
Well,
right?
You said a very interesting thing, which is choice. And I will say that when Brad and I first started going out, I don't necessarily feel like that felt like a choice. I didn't sit down with a pro and con list. When you fall in love with a giant thunderbolt, there are choices around that, including how you behave and whether you continue. And Brad actually does say, you knew what you were signing up for. And that usually was in a defensive posture when I would be struggling with his 100-hour work weeks. And one thing I would also say is, yes, you think you know what you're signing up for, but you are always allowed to renegotiate and redecide. And I think that's a really important factor because at 23 and 24, when we first started going out, we didn't really know. You don't know. And so you need to be able to constantly be talking and communicating about what's working and what's not working. And yes, I had known Brad since the spring of 1985, all through college. He was at MIT and he worked crazy amounts. And that was attractive, right? The commitment and the energy level and the creative output. But there became a time when I said, I really do want to renegotiate our agreement. And one of the things we wrote about it in our relationship book was to be as explicit as possible in what your contracts are with each other and with yourself. And to your point about knowing yourself, right? What's working and what's not working, and that it's your responsibility to communicate what you need and not expect your partner to be a mind reader. But in our late 20s, it was really challenging to be married to an entrepreneur who kind of thought he had free reign to just work as much as he wanted to work, which was apparently all of the time.
We had a thing early that became a definition that was really helpful, is at least for me to understand, was Amy basically defined work as any time I was not playing with her. And the boundary was useful. Or the definition of the boundary was useful. Sometimes it was, frustrating and difficult and hard to process. But like being explicit about, as one partner, what your expectation is when the other partner's default. In my case, my default was just to work.
Amy mentioned 100-hour work weeks. Okay. That doesn't leave a lot of time for much else. So getting into a relationship as somebody who was so dedicated to working and trying to figure out how to make space, right? And meet expectations. And I'm sure both of you had to budge on either side of that. But your mindset shift that had to occur over that period.
One of the things that I remember was I didn't really perceive that I was working 100 hours a week. And so, the tempo and momentum and focus around it, there was space for other stuff. But the other stuff fit in the cracks from Amy's perspective rather than being deliberate and defined well.
Being the accountant and seeing those billable hours was fruitful. And then we tried, and that's a key word, right? You keep trying different things, and the willingness to keep trying different things is absolutely foundational, where I would say, let's put an upper limit of 80 hours a week. That conversation hasn't changed. The specifics of it have, and I think I approach it with a much lighter, more humorous touch than I did in my 20s.
I think I'm less defensive too.
So both of you moved a little bit and met more in the middle.
Yeah, there was a moment in time about 10 years into our relationship that was a real sort of quasi-cataclysmic moment, which was also at the point at which the internet bubble was collapsing. So my world was a mess. And I was already working constantly. I had been working constantly for that previous decade. I was traveling all the time. And we had a weekend with friends where we met in Boston. Amy flew to Boston. I was already on the East Coast for some reason, and we took a car to Rhode Island to our friends' houses. And, you can, when something's wrong with your partner's angry at you, you can usually tell. And we get into bed and, we're getting ready to go to sleep. And Amy says, kind of very quietly, "I'm done." And my response to her saying I'm done was, "Yeah, it was a lousy week. I'm really done. I'm looking forward to the weekend." And, generated, well, I meant something different, Brad, by "I'm done." And it was, "I think you're awesome and I love you, but I hate what you're doing to yourself. I'm not having any fun. This is not how I envision, the relationship." And that generated about an hour conversation because I wasn't done and I didn't kind of process.
I was even more explicit than that, which was I said I wanted a divorce.
Conversation.
And I wasn't angry. I was like, I'm not even angry anymore. Like I've said the same thing over and over again, and you say all the right words, but your actions don't change. And it just was not how I wanted to live. And the other part was he was really, really suffering and struggling, and his mental health was not in a good place, and his physical health was not awesome. And I was really at my wits' end about what else to try.
Yeah, you hit the wall. You hit the proverbial
That's
wall, right? As a couple, and something's got to give, or you part ways and continue on separately.
In that moment, and again, 25 years ago, we created enough space for each other to start to understand what the fundamental problem was. Because for the previous 10 years, whatever the behavioral dynamics, mine, between us, however you want to say it, we're not getting at the root cause of what the actual problem was. And it turned out that the root cause, I think, was pretty simple. When I talk about it, when I think about it, which is that my words didn't match my actions. And the essence of that was, again, simple, because the specific words were to Amy that she was the most important person in my life. But my actions didn't support that. I really didn't have a good understanding or handle, not just on that, but on how to set boundaries for myself in the context of this entrepreneurial life where, the amount of stuff I had was infinite. The amount of things that could consume my time were infinite. And so it was really up to me to start to put some parameters around that or some boundaries around that so that I'd have time not just to play with Amy, but also have time for me and to take care of me and do the things that I needed to be healthy long-term and able to sustain a level of energy and intensity that was satisfying to me.
Yeah. Well, and I imagine that's something that a lot of professionals deal with, entrepreneurs especially, that it's sort of this mentality of, well, if the harder I work, if I just work, I will be successful, right? I will finally figure it out. And that's not how it works, frankly. And you wrote in the book that sometimes success can be just as difficult on a relationship as failure can be. So let's talk about that for a second, because I think that's an important message.
Well, two pieces to that. And I think Amy has a wonderful calibration on what success means. But as a precursor to that, think of the cliche, just one more email. And this, It's time to go. And, we have, whether it's in 25 years ago where I'd be late to something, but I have no way to communicate I was late because Amy didn't have a phone. She's at the restaurant waiting for me, or she's waiting for me to get away from my computer and put my shoes on to get out the door. And this sort of behavioral dynamic of waiting and being the one that's always waiting is fundamentally unsatisfying. And this idea of being partners, equal partners in the relationship, also means it's not okay that from our perspective and from the health of our relationship that Amy's always waiting on me, or that I'm always trying to make up for the thing that didn't work, or trying to soothe and placate the thing that caused the friction. So independent of what success actually means, I think the precursor to it is recognizing, are you in a relationship and do you believe that you're in a relationship where you're equal partners, independent of the financial dynamics, independent of the work dynamics, independent of like the responsibilities and how you choose to allocate your time and spend your time. But is that starting point equal? And that was, for both of us, really fundamental. And I would say probably a red line for both of us, among a couple of other red lines, that if we didn't treat each other as equals in our relationship, it wasn't going to work.
So let's stick on that for a second, because that was actually where I wanted to go next. Because this is a money podcast, after all. This is an investing podcast. So the next piece of this is when you first started dating, or maybe when you first got married, you correct me with the details, but Brad, you were making 10 times more than Amy. So there was a wide swath in between, right? If that's how you define somebody's contribution to a relationship, there was a big birth between the two. How did you establish that? Number one, establish shared money values, and how did you arrive at the place where each partner felt like an equal partner? And also, this is just me. I personally am interested because I just recently had a baby. I have a 7-month-old baby. And I mentioned my husband, thank you. So now I'm back at work, and we had a couple conversations, sometimes tense, right? But we're both equal parts of this relationship, this life, this marriage. So talk to everybody about how you got to that middle place.
It is so complicated.
It is hard.
I think some of it was literally initially when we would go out, I would want to contribute 50% of the dinner bill, for example. Like I really wanted that financial parity. And the fact that then he made 10 times more money than I did, and I knew it because I was the accountant, we did shift toward a percentage contribution. And I do think there's some wonderful advice books for people starting out in relationships about, partner one's money, partner two's money, and partner together money. And I think that was really helpful. But equality is tricky, right? We each have different skills on the investing thing in particular. Brad is actually an investment professional. It's what he does. It's his genuine expertise. But I'm educated about it. I wanted to be involved. And I think we have approached some of those pieces in a really business-like and professional way, which is to say we have meetings about it. And we did have measurable goals, all of the basic management pieces, right? Where what metrics do we care about? What are we going to measure? And then are we contributing? And the financial piece doesn't have to be, obviously, is not equal contributions, but the idea that you're contributing equally to the relationship, because those intangible things, Brad's actually was raised by an artist mother. And I think that's part of it too, that creative work that, she made money at, she's still very successful, but a good financial year for her would be when she sold enough art to pay for her art materials. And Brad's dad was a doctor. So they were never going to contribute equally into the financial parts of the marriage, and they're still married 60.
Yeah, I think an important thing they modeled for us was that they were equal partners in their relationship. Early, we talked about it, and we talked about it in a way that wasn't with a power dynamic. It wasn't, okay, I have this tool called money, and I'm going to use it or withhold it as a way to try to get something different in the dynamic of the relationship. Instead, let's talk about what we're going to do with this money that we have.
And I think that is a really important distinction, right? It's a different way to frame it. So instead of developing a strategy for who's making the money, who's making more, whatever, where's the money coming from? It's think about what the money is for. What are you going to do with it?
Money is a tool. And values-based money decisions are key, right? Money means a bunch of different things, all arbitrary and artificial and made up and real, in terms of it being freedom and security, generosity. But we're very aligned in our values. And I think that's a key piece, both to money relationships, but all pieces of your relationship to really be specific about what your value systems are and what the hierarchy of your values is.
Very early in our relationship, we talked about, like, what does it actually mean and what does success mean for us? And in some ways, that 10-year moment that was such a low point was a definition of failure. Because success for us, for both of us, was to have a successful marriage, a happy marriage, to be happy with each other, and to grow old together, and that that was part of that definition. But as we talked about it, even though we came from very, very different frames of reference from what we grew up with, I think our goals and our motivations were intertwined. And I think powerfully being in a relationship where that can be part of the experience, where you're defining it for each other and you're going through the ups and downs, because there have been plenty of things that we've both been involved in that were not successful endeavors. The individual company that was a failure, the individual project that was a failure, the friendship or relationship that was a failure, the thing that we thought for sure was going to be really fun and exciting that turned out to be a debacle. I think we like to think that most of the big decisions that we've made together have been good ones, but we've had plenty that weren't. And having the ability, resilience, willingness to work through those things when they don't go as you think. And then on top of it all, understanding different styles. And an example of that would be on decision-making. I tend to be impulsive. I tend to, have the decision in front of me. I want to get the decision done.
I'm not sure that Brad's so impulsive as much as he's able to synthesize a lot of data information more quickly than I am. We make decisions quickly, and if we make a wrong or bad decision, we make a different decision quickly. Sunk cost, I think, is a key economic term that many people don't actually implement fully in their personal lives as well as their financial lives. And kind of that didn't work, and we're going to move quickly to the next decision. We're not maximizers, we're satisficers.
Oh, I like that.
Yeah, that's a Barry Schwartz book, right? The maximizer versus satisficer, the paradox of choice.
Okay.
That there is, you can overthink a thing or be too slow and miss a window of opportunity. So I think we're actually quite fast.
It's a good one. We're very aligned on that.
Right. So, Brad, I can't let you get out of here without talking about the Rule of 40, because we are in a tech-driven environment right now, and the Rule of 40 has become a little bit more mainstream. It wasn't something that most people talked about, and now they're talking about it again. Historically, it was about software companies. So just run us through, for anybody who's not familiar, what is the Rule of 40 and why does it matter?
Well, Rule of 40 is a very simple formula, which is growth rate plus EBITDA percentage. And it's an approximation for health of a company. So if those numbers, your growth rate percent plus your EBITDA percentage is equal to or greater than 40, you're healthy. If it's less than, you have some ways to go. Where it emerged from was in especially SaaS companies, to get the ratio between growth and spend. And so, for example, you had a lot of companies that would be growing 100% year over year, but were losing money. And, how much money can you lose to get 100% year over year growth? And what level of comfort do you have with that? Very crude, but it turned out to be actually quite a good, quick number. And the linkage to me is I popularized it along with Fred Wilson. I don't think either one of us invented it, although it's entertaining to have the internets think that we invented it. But we both heard it in a board meeting that we're at. And if you go back and look at the source blog post that I wrote about it, we talked about being in this board meeting together where both of us sort of looked at each other and said, that's interesting. And, started using it from there. What is useful to recognize in the context of high-growth private companies and public companies is that the metrics about what people talk about for norms at any given time tend to be some combination of forward-looking suspension of disbelief about what's going to happen in the future that's going to make the company dominant and wonderful, and current reality about what the current sentiment in the markets are with a looking backward phenomena. So to stay out of, we can talk about it, but to stay out of AI crazy valuation bubble land or whatever you want right now, and just look back during COVID. And, pre-COVID, if you looked at growth rates of companies that were SaaS businesses and you looked at multiples of revenue, you tended to have, depending on Rule of 40 and where the company landed on that, a multiple of revenue that ranged somewhere from 1 times revenue, which would be companies that typically weren't growing, even if they were breaking even. And at the other end of the spectrum, companies that were growing 100%, 200% a year might get a 10 times revenue. And what has been useful for us and for me on a looking backwards perspective is long-term durable value is different from short-term speculative value. And when companies are really young and really tiny, it's very hard to be able to believe. You have to believe, but it's very hard to believe that they're going to have long-term durable value. And so they tend to be that belief tends to be a fantasy that's overvalued. You speculate that the long-term durable value is going to be there, and you try to extrapolate from whatever the growth is. When companies are meaningful businesses that have real metrics, and meaningful doesn't even need to be billions of dollars of revenue. It could be, tens of millions or hundreds of millions of dollars of revenue. All of a sudden, in some ways, they're hamstrung by the fact that people can look at the business and say, oh, this is how the business is doing. And so you have this very weird thing, especially in the private markets, where the private market investors are constantly looking for, all right, well, if I don't want to really concentrate on what the financial characteristics are. I just care about how fast you're growing. And if you're growing really, really fast, all the rest of that stuff will take care of itself. And history as a guide, for the edge case companies, yes. But for the vast majority of companies, not so much.
So what do you think about the current environment for startups or companies that are IPOing? Because there's a lot of chatter about it right now. There's, chatter about there being a bubble in private markets. There's chatter about IPO activity picking up, and that's a good thing. But we also use it as a little bit of a barometer for over-speculative behavior. What's your take on where we are right now?
I think a healthy IPO market is a good thing. So I'm hopeful that there is a pickup in the IPO market from where it's been. But I separate that completely from anything else, because the public market values and the dynamics of the public market values being inflated are very, very different than when companies go public. If you look at private company valuations, especially smaller and younger companies, we're in a moment of total and complete suspension of disbelief in a lot of different areas, again, around speculative investment activity because of the promise and hype and belief of what's going to happen with generative AI and how it's going to be transformative to everything. And you're already seeing situations where entire categories of newly started companies are made obsolete with a feature change or a product rollout from an established company. You have another dynamic, which is you've got a bunch of private capital going in at later and later stages at inflated and ever-inflating prices. Often those ever-inflating prices are being marked up by the same investors. And you have a situation where the scarcity dynamic pulls a lot of capital in that doesn't really have an understanding of what's going on with those companies. So I would say that there's another layer of it where you have these very highly valued companies that are raising lots of money, where nobody is really getting underneath the next level and saying, what's the economic durability of this business long term? And then you have a new phenomena that's probably only a couple of months really visible, but was part of the giant bubble inflation in both the internet bubble and the telecom bubble, and then again, in the financial crisis with the subprime bubble, whatever you want to call that, subprime mortgage crisis or whatever the labeling is now, which is some version of round tripping, where company A pays company B to then invest in company A, or company A invests in company B to then pay company A. And, the bigger those deals are, maybe they could work out, but, history has shown us that they don't work out that well. And in a lot of cases, there's speculative activity that's kind of extreme around that. And, the tell from my frame of reference is when you see public companies, large public companies see value increases in their stock of 20, 30, 40, 50% because of a deal that's announced. Where the deal, nobody even really knows what the deal means.
In a couple days.
Yeah. So that's anybody that says, "Oh no, well that's fundamental investing," nonsense. That's speculation. The speculation could be right. I'm not going to judge. I don't invest at that level. I don't really care that much, other than the fact that I think, what's the joke? We should just buy lots of popcorn. Make sure we have plenty of popcorn on hand when it gets really, painful. The painful part, though, does impact the companies and the investments that we make, because so many of those companies rely on a healthy, growing ecosystem of other companies, especially in the tech industry. It's now woven through everything. And because it's woven through everything, the impact it can have is quite dramatic. And you have this endless, dynamic of innovation and change and challenge, and really, in a lot of cases, economic destruction of incumbents as new things happen. We are in this weird moment where, especially within the public markets, a relatively small number of companies dominate the value. And then in each category that you go into, a relatively small number of companies dominate that category, whether it's pick any category you want. And that doesn't feel great in terms of long-term durability.
It's fragile. It's fragile. And if you look back over history, actually, and before most financial crises, you end up in a situation where the market is dominated by the top 10 to 15 companies. And right now it's fewer companies. Usually it's about 15. But to your point too, tech now is in everything. This is a stat that we just figured out, and that people don't talk about enough. I'm sure people knew this stat before, but people don't talk about it enough. Before the internet bubble, technology was less than 6% of the S&P 500. And now if you take the tech sector plus the Magnificent Seven stocks that are not in the tech sector, it's 50%. So we're dependent on it, not just in our daily lives. Every single industry is dependent on technology, but we're dependent on it financially to continue doing well and continue, what do you call it? Continue its suspended disbelief in order to keep that going.
Yeah. I think that one of the challenges from a financial perspective as an investor, is the cliche that's said over and over again. You know that you've got to get off, the merry-go-round at some point. You just don't want to get off too early, and you don't want to stay on too late. As a couple, and it's interesting, as you get older, you sort of look at it and you're like, you know what? Is that really the interesting thing that's going on? The trees don't care that much. The rocks don't care that much.
But you get so engulfed.
Yeah, what is it
that
really matters here?
Returning to those core values about connection and relationship and enoughness, abundance, feeling a sense of abundance. And for me, that actually came very early, before any gigantic financial success, right? To feel autonomy and agency and have savings and be able to help other people. Those values haven't changed at all, no matter what the number on the balance sheet says. So that's a core value piece too. And we are not high risk public market investors.
What Amy was very enlightened early about was this notion of agency and abundance, and defining agency as having the ability to impact it yourself, and abundance is defining what you need at a relatively low level, so you are exceeding it. But I think defining those things as a couple and then weaving that into the way you approach everything you're doing helps a lot. And I see so many people that have friction in their relationships because, especially when they have great wealth, because they haven't really defined that very clearly for each other.
Well, Brad and Amy, thank you so much. This has been such a unique episode, and I knew it would be, because it's the first couple that we've had and the first time that we've been able to talk through money decisions as a couple. And I think it's been really helpful for me. I'm sure it's been helpful for our listeners. So thank you so much for spending your time with us
Thank you
today.
for having us.
Our pleasure.
Congratulations to you and your husband and your baby.
Thank you. Thank you. Thank you. Well, that was a masterclass in how to build a relationship, have a career, figure it all out along the way. And they said they were married for 35 years. So they've been working on this a long time. So a couple things, and the important parts to me, the big takeaways that I had. It's a process. It is a never-ending process. You don't ever really arrive at this moment where you've decided that you've figured it all out to build a relationship while building a career. And the idea of trial and error throughout and continuing to try new things to make it work, and the relationship just evolving over time because of all the things that are changing throughout a career and throughout your life. I think that's a really important way to look at it. And then a more money-focused thing to think about and take away from this was I loved their idea of deciding what you're going to use your money for, rather than worrying about where the money is coming from. And that helps you align your goals as a couple. It helps you think about your bigger purpose and what's really important to you. So I loved that episode. I learned a lot. I loved listening to them talk about it. And it's always easier to watch somebody else who's already gone through the work and take their tips. So thank you for listening, and we look forward to bringing you the next episode very soon. For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strapp. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Elizabeth Thomas is a registered representative of SoFi Securities LLC and an investment advisor representative of SoFi Wealth LLC. SoFi Invest encompasses two distinct companies with various products and services offered to investors as described below. 1. Robo-investing and advisory services are provided by SoFi Wealth LLC, an SEC-registered investment advisor, SoFi Wealth. Brokerage services are provided to SoFi Wealth LLC by SoFi Securities LLC. 2. Active investing and brokerage services are provided by SoFi Securities LLC, member FINRA SIPC. Clearing and custody of all securities are provided by Apex Clearing Corporation. Individual customer accounts may be subject to the terms applicable to one or more of these platforms. For additional disclosures related to the SoFi Invest platforms described above, please visit www.sofi.com/legal. Neither the investment advisor representatives of SoFi Wealth nor the registered representatives of SoFi Securities are compensated for the sale of any product or service sold through any SoFi Invest platform. For a full listing of fees associated with SoFi Invest, please view our fee schedule. For additional disclosures related to the SoFi Invest platforms, please visit www.sofi.com/legal. Copyright 2025 Social Finance Incorporated, all rights reserved.